Hey, hi everyone. Welcome to another edition of Stay at Home. My name is Bhaskar Sankara. I'm the editor and publisher of Jacobin magazine. And several times a week at 6 p.m. Eastern, I've been joined by a left-wing thinker who's been making an argument. Then we've been doing a Q&A with our live audience. So please, if you want to participate in that Q&A, just sign in and leave your comments in the YouTube chat and press subscribe and like, because that's how we get the video out to more people. Today was actually a bit of a difficult day on the Jacobin home front. Our website was down for most of the day. So if you haven't subscribed to Jacobin, the website is back up and we have about 16, 17 hours of lost revenue to make up for. So please do subscribe today. There should be a discounted subscribe code in the description. But we are still plowing ahead with all these videos. On Friday, we have Peter Gowan, who'll be talking about the Meidner Plan, one of the most inspiring periods of social democratic practice, which was the attempt of the LO and the left wing of the Swedish Social Democratic Party to create a wage earner fund that would have slowly socialized production in the 1970s. And why that plan fell apart, why it was never actually pushed through to fruition, gets to a lot of the limits of social democracy, but they're still really instructive. When we've seen similar plans for wage earner fund take root in John McDonnell's office, when Corbyn was labor leader, we saw a bit of it in Bernie Sanders' plans this last election cycle. So it should be a really important talk. Peter Gowan is a very entertaining speaker, so I'm looking forward to that. But today, we have a very excellent speaker, a Catalyst board member, and a professor at Colorado State University, Ramaa Vasudevan, who will be joining us to talk about the role of the Fed in this current crisis and how Fed policy is being used to bolster the power of the banks. And Ramaa is also the author of Things Fall Apart. She's written an excellent piece in the last Catalyst, or two Catalysts ago. And she has an upcoming piece in Catalyst, as well as some pieces coming on the Jacobin website. So Ramaa, thank you so much for joining us. The left is, in general, I hate to say it, most of us on the left are like me, humanities graduates. So we're definitely in need of smart economists who could tell us things, and you do so in such a legible way for non-specialists. So I'm looking forward to this talk. So please go ahead, and then for everyone watching, obviously, press subscribe, press like, and please do leave comments, and I'll pass along some of your questions to Ramaa when she's done.
Thank you, Bhaskar, and thank you for organizing this, you and the folks at Jacobin, and I'm thrilled to be here. So the global rampage of the COVID-19 virus has battered lives and livelihoods of working people across the globe and in the US. In the US, more than 100,000 lives have been lost. And since the lockdown, 39 million jobs have been lost, and there's no end in sight yet. Unemployment will easily reach 20%, and these losses dwarf the worst months following the great financial crisis. But there's been a different kind of blow which the pandemic has struck. So in March, the stock market crashed, wiping out a chunk of the gains of one of the longest stock market booms in the US. But even as the toll of on the lives and livelihoods continues, if you look at the S&P 500 index in the graph, you can see the crash. But in April, about 1/3 of these losses have been recovered, and April has been one of the best months for the stock market since the 1987 crash. This is pretty amazing, and the US Federal Reserve has played a pivotal role in the revival of financial markets. And today I'm going to talk about what the Fed did. But even more important, there's this huge contrast, this gulf between the Fed's swift and extraordinary interventions in response to the pandemic and supporting the financial markets. And if you contrast this with the faltering, fumbling response to the humanitarian and public health crisis that has been unleashed. So the other question I want to address is, how is it that the Fed could act in such a far-reaching way to protect the financial system when the response of the US state on this other front was so fatally ambivalent? Okay, so to understand the Fed's distinctive role, we need to understand the deep ties that weld the US Federal Reserve and private finance together. Finance is the fuel for the engines of accumulation, but it's not just that. It's also an expression of social relations and power. Now, it is hard to contain private finance to its productive role in the economy because the quest for returns is continually sparking risk-taking speculation. And so the inevitable crash happens, and when that upends the economy, the Fed pulls the lever to prevent the financial system from running aground, and it tries to kickstart the machinery. Now, the metaphor which captures this pivotal axis of the Fed and private finance is what Andrew Haldane, a chief economist at the Bank of England, called the doom loop. So what this doom loop is, that basically the story is that as the speculative excesses and myopia of private finance brings the system to a halt, it becomes imperative for private finance to be rescued, because without that, the regime of accumulation is endangered. But with each rescue, finance gets a free rein, it strengthens itself, and fragility builds up again, and the bets become even larger. So the Fed has, in the next round, it has to ratchet up its support, otherwise the fallout will be bigger. So this is a doom loop. But the doom loop is embedded in the growing power of finance and the entanglement of the Fed in the logic and imperatives of finance. We saw this doom loop in action in the Fed's heroic rescue in the financial markets of 2008, and in the embattled and stalled initiatives to tighten regulations once the crisis was over. The same process is underway today, but the landscape of finance has changed, but even if the Fed is still at the center of the storm. So let's see where this all began. It began in March. As the story as the virus was spreading across the globe, and the first tremors were felt in the stock markets, and oil prices both plummeted. But in a really freakish ripple effect, the tremors were felt in the market for US Treasuries, which are considered the safest assets in the spectrum of financial assets. Now, normally when the stock market crashes, there's a rush to basically buy up US Treasuries, which are safe. But in March, there was this big dash for cash, and there's this huge sell-off of assets. And as investors found they couldn't sell bonds and stocks, they began selling US Treasuries because these were easier to trade. So there was a sharp collapse in the stock market and in the US Treasuries, a very unusual event. And what this basically is a symptom of is a global thirst for dollars. So you can see in the graph, as volatility increases, and this is the volatility of 10-year Treasury bonds, the dollar index also rises. The dollar index is, in a sense, a symptom of the panic in the market. And when this panic struck, the Fed stepped in. It bought more than $700 billion and pumped money into the banking system. But these early interventions did nothing to calm the market. And so the Fed pulled out the emergency toolkit it had cobbled together when Lehman Brothers collapsed in 2008. It started buying up a wide range of assets. It opened a spigot of lending. It opened new facilities to buy up US Treasuries, and even more than that, to buy up short-term assets like commercial paper, money market mutual funds, and also assets which are backed by things like credit card debt, student debt, and auto loans. So what the Fed is trying to do is, by buying directly and lending against all these assets, which have become increasingly toxic in the market. It's trying to provide a backstop. It's putting a floor on the crashing prices so that trades can get going again and the credit machinery is moving. Now, these interventions are pretty extraordinary on their own, but they were essentially rejigging the unconventional monetary arsenal which the Fed had used in 2008 and 2009. At that time, the crisis was set off by the implosion in the market for subprime mortgages to low-income households. A vast financial machinery had been erected on the basis of predatory loans through off-the-book shadow banks. Now, traditional banking is based on the bank takes deposits, it gives loans. And traditional banking is regulated by the Fed. The shadow banking system instead lends by slicing up and repackaging illiquid and risky assets like subprime mortgage loans through the process of securitization. And it borrows through the short-term money markets. Now, when this market for subprime mortgages collapsed, this house of cards was brought down, the financial system came to a grinding halt. And the Fed was at the center of the storm. It launched a massive program of buying and lending against toxic assets, including mortgage-backed securities, which had sparked this crisis. So it basically absorbed the risk onto its balance sheet. Now, these unconventional monetary policies definitely helped avert another Great Depression. But what they didn't do is address the fault lines that had been exposed and had caused the crisis. Now, this proliferation of the shadow banking system is rooted in the structural transformations that were set in motion in the 80s. The exacerbation of inequality, the concentration of wealth and income. And this was the result of a changing balance of class forces, which led to a rising share of income and revenues being captured by a narrow corporate elite and a squeeze on working class incomes. Now, this structural transformation was driven by the growing power and dominance of finance and Wall Street. So when the Fed bailed out the banks to prevent a collapse, these structural drivers were left intact. And in fact, the power of finance was further consolidated. There were mergers and acquisitions. Four big banks, Citibank, Bank of America, JP Morgan, Goldman Sachs, emerged from the debris of the crisis to dominate the financial sphere, even more highly concentrated. But now, more than a decade later, the trigger for the financial meltdown was not the excesses of private finance, but the spread of the pandemic. The Fed is at the front lines, trying to avert the implosion and restart the credit machinery. But both the scale and the scope of its current interventions have gone much, much beyond what it had undertaken during the 2008 crisis. If you look at the balance sheet of the Fed, this is the assets. It's added more than $2 trillion to its balance sheet since March 16, basically by buying up a range of securities. Its balance sheet has now risen to 6.7 trillion, about 30% of US GDP by the beginning of May. But what is the scale is incredible. But what is truly significant that the Fed has also entered a new terrain, and that is the terrain of corporate lending. This terrain had been off limits until now. So what the Fed has done, and you can see it in the picture. So under the CARES Act, $450 billion of funds has been earmarked for the Treasury, the US Treasury, to inject into the Fed. And the Fed then has set up separate offshoots to support loans and loan guarantees to businesses and to buy back corporate debt. Now, each dollar in the hands of the Fed has a capacity to support up to around 10 times that amount in debt. So this $450 billion could be leveraged up to support more than $4 trillion of debt. That's 20% of GDP, of US GDP. And and the capital injection by the US Treasury into the Fed provides a cushion of risk so that the Fed, which has taken on this risk, has a little a cushion. Now, this partnership between the Fed and the Treasury is blurring the line that separates fiscal and monetary policy. But it also throws into sharp relief the Fed's role as a channel through which risks and fragility of finance is going to be absorbed and passed on to the working class households. Now, there are three prongs to the corporate bailout. The first is Main Street Lending Program, which is trying to support mid-sized businesses. And what this program does, it buys 95% of the value of loans off the banks which have made the loans. The idea is to prop up loans of up to $600 billion in the banking system. But the exact terms and conditions of these loans are still a bit fuzzy. There is a nod to the need to restrict firms who've got these funds to use them for dividend payouts, to buy back shares, or for CEO compensation. There's also a nod to get a commitment to preserve jobs and payrolls. But even as this program is being launched, the eligibility for these loans has already been relaxed to include riskier companies. The commitment to preserve jobs has been watered down to what's called good faith efforts. Okay, apart from this, a really far-reaching new initiative is two new facilities that have been set up to buy up to $750 billion worth of newly issued corporate bonds and bonds traded in the secondary market, including exchange-traded fund shares. With this, the Fed has ushered a new era of central bank policy. It's taking a huge leap, directly buying and selling marketable corporate debt. So it stepped beyond the traditional role as a backstop to banking in 2008, when it embraced the world of shadow banking. Now it stepped even further afield, outside the sphere of banking institutions, to support the flailing market for corporate debt. I mean, this is momentous. It's also an explicit recognition that US non-financial corporations are deeply embedded in finance. It reflects the power of finance, the pervasive control that finance exercises over non-financial corporations. Now, the significance of this development will become clearer when, in the context of the profound changes which have happened in the financial landscape since 2008-9. And there are two important trends which I want to focus on. The first is the rise of the asset managers. Asset managers are basically, they include mutual funds, hedge funds, private equity, index funds, exchange-traded funds. Now, what they're doing is managing financial assets on behalf of investors and clients. So unlike banks, they don't hold deposits and they don't engage in trading on their own behalf. They're agents of investors, and so they don't keep the risks of investment strategies on their own books. Because of this, they have claimed exemption from new regulations which are put in place after the 2008 crisis. This is the Basel III standards and the Dodd-Frank Act. And what these rules did was they imposed a heavier burden on big banks, which are now supposed to keep larger buffers of both capital reserves and cash, high quality liquid assets on their books. Asset managers don't need to do that. The other important trend is within this asset management universe, there's been a shift from what's called active investment strategies to passive. Now, active investment strategies are basically when the manager is picking and choosing winners and losers and is actively trying to beat the market. Now, we saw how that went in 2008 and 9. But since then, finance, not to be deterred, brought in a new strategy, the passive investment strategy, where now a fund will track a curated bunch of assets. It could be an index like the Standard & Poor 500 index. It basically tracks that. So it's supposed to have less volatility and lower fees. So this, and this passive investment fund universe has really grown, and it's eclipsed the active management sphere by 2019, last year. Now, the sphere of asset management is not just become, it's grown, it's become $74 trillion in 2019, but it's also highly concentrated. There are three groups: Blackguard, Vanguard, and State Street. Now, they control a major share of the assets managed by the sector globally. And they've also captured an increasing share of the funds flowing into the sector. And of these groups, BlackRock became the largest asset manager globally after it acquired Barclay Global Investors in 2009. It's trebled in size since 2010. Now, in 2008, BlackRock was tapped by the Fed to manage the assets of Bear Stearns and AIG when they collapsed. Since then, BlackRock has built not just a financial empire, but a formidable network of political connections and financial heft. It's a kind of a reprise of Goldman Sachs playbook. It uses political clout, advising and consultancy, and has forged deep connections with Washington, the Treasury, the Federal Reserve, and Congress. But the big three, BlackRock, Vanguard, and State Street, they've emerged. I mean, it's a concentrated sector, but it also has huge ownership stakes in across the economy. It has ownership stakes in all the big banks: Citibank, Bank of America, JP Morgan. It holds about 1/5 of the Standard & Poor 500 companies through the funds they manage. It's among the top shareholders in most of these corporations. In many sectors, you'll find these three funds. They have ownership across firms in that sector. So it has stakes in most firms in big tech, in airlines, in hospitals, in pharmacies. So they've become a really pervasive influence. And this common ownership by the big three across the corporate world and the concentration of holdings with them means that they have the power to determine things like who's on the executive board of companies. They can shape company policies, from everything from executive pay to strategies for dealing with environmental and sustainability goals. So the control which finance has asserted over industry now goes beyond the control which big banks assert through shareholdings, interlocking directorships, and their lending practices. Now, this web of control has been penetrated by asset managers like BlackRock, who have the power to recast the rules and norms of corporate governance. And they can do this in ways that will consolidate their control and concentrate wealth in their hands. So from being scrappy outsiders, they have now a place in the inner sanctum of the power brokers of finance. So the extent of the clout can be seen in the very successful campaign, which, led by BlackRock, they mounted to dodge the label of being too big to fail after 2008. Now, this too big to fail basically is a label which imposes rules and regulations to prevent these too big to fail financial institutions from imploding and taking the economy down with them. But BlackRock launched an aggressive campaign. It lobbied, used campaign contributions, networking, and basically dodged this label. And so it also dodged the rules and regulations which it would have incurred. And this leeway has catapulted big asset managers to this place they have today. Now, these passive asset managers may not follow the cutthroat, myopic strategies of private equity and hedge funds, but their market and industry-wide stakes have reshaped finance. They can orchestrate flows and allocate investor portfolios, and the concentration of control in a few hands basically amplifies the risks of market disruption. There are many risks, and I won't go into all of them. We can talk about it, but the most important is herd behavior. In these passive funds, investors can kind of crowd into certain sectors and then stampede out. And when they stampede out, they pull out money and the fund comes crashing down. So these vulnerabilities were pointed out. They were pointed out in a report which was commissioned by the Financial Stability Oversight Council. This is a federal body which was set up after 2008 to monitor risks to the financial system. Despite this report, which pointed to the vulnerabilities, this council declared asset managers exempt from the too big to fail label as a tribute to BlackRock's successful campaign. But risk in the financial markets is never banished. It finds the weakest link. And the weakest link, where the cracks appeared in this financial system, turned out to be the market for corporate debt. Now, since 2008-9, there's been this, interest rates have been really low, and non-financial corporations in the US have basically gorged on debt. By 2019, corporate debt had crossed 10 trillion, which is about 47% of US GDP. But what's even more important, that bulk of the debt wasn't loans. It was marketable debt. It was bonds and other securities. And the share of this marketable debt, bonds, corporate bonds, etc., rose from being less than 50% in 2009 to more than 70% in 2019. So corporations are borrowing more, but a big chunk of their borrowing is not through bank loans, but from capital markets. So while the corporate sector, the non-financial corporate sector has got deeper in debt, it has not used this debt to build productive capacity. It's been using this debt to promote financial accumulation. The bulk of this debt is being used to fund payouts to shareholders, to buy back stock, and for mergers and acquisitions. So this growth of debt is in some senses resting on shifting sands. And the signs of corporate vulnerability have been growing. One sign is the share of riskier bonds, which is at the lower end of the investment, the credit ratings spectrum. It has grown from 18% in 2010 to 45% in 2019. The market for leveraged loans, this is, companies which can't even issue junk bonds, they take leveraged loans. This has exploded. It's nearly doubled since 2009 to reach 1 trillion in 2019. So corporate vulnerability, the vulnerability of corporate debt has been growing. And as the stockpile of low quality riskier debt rose, huge holes were created in the balance sheets of asset managers, because as fire sales are triggered and investors started pulling out their money, and this is especially true in this corner of the financial sphere called exchange traded funds. They are passive funds, but with an additional wrinkle. You can trade them throughout the day, so they're even more liquid. So a thinly traded asset like a corporate bond, which doesn't have such a deep market or such a liquid market, you can dip your toes in it through this exchange traded fund. And this sector was hit as the corporate bond market collapsed and investors pulled their money out. In fact, the big three asset management funds, the BlackRock, Vanguard, and State Street, they lost about $2.8 trillion between January and March. BlackRock alone lost $1.4 trillion. Its profits fell by 23% in the first 3 months of this year. So this is the context for Fed's extraordinary incursion into the market for corporate bonds and exchange traded fund shares. It had already taken on the debt of the banking and shadow banking system in 2008, and now it spread the safety net to absorb this segment of the market. And it's doing this to keep these markets moving, to keep them from stalling. So the crazy thing is that the mere announcement of this backstop sparked a rebound in the market for junk debt. So in April alone, about 32 billion worth of junk bonds was sold, including bonds of Carnival Cruise Line, which was one of the trigger points for the COVID outbreaks. And this sale is the highest in the past 3 years. I mean, this by itself is pretty incredible, but even more striking aspect of this unprecedented foray by the Fed into the market for corporate bonds is the fact that the Fed gave the reins of running the special entity it created to buy corporate bonds and corporate ETF shares to BlackRock's consultancy arm. And this when BlackRock is a key player in this market. So in some senses, now BlackRock's position as Fed's partner and in the doom loop has been enshrined. Not surprisingly, on the day of the announcement, about $1.5 billion poured into BlackRock's exchange-traded funds, assuring it about $2.3 million in fees. So the sphere, I mean, it's not just BlackRock, the sphere of asset management has become more concentrated, and asset managers have become even more powerful in the wake of the pandemic. They have, they've increased in size, and the top 1% in particular has grown relative to the bottom 50%. The banks and asset managers are also mounting an offensive to relax and rewrite rules and regulations, pleading the onerous burden imposed by the pandemic. So the arc, in some senses, is come full circle. The doom loop is back in action. Now, this power of in the hands of asset managers like BlackRock and Vanguard has been compared to financiers like JP Morgan and Rockefeller in the early 20th century. At that time, there was this cabal of financiers, the money trust, which controlled industry. We can go even further back. We can go to 19th century England, when the market for sovereign bonds was concentrated in the hands of two financiers, Rothschild and Barings. They dominated the city of London. They dominated international financial markets. So in these periods too, we see the same thing, the concentration of power and control in the hands of big finance, and the deep nexus which tied big finance to the state. And this nexus implicated the state in preserving and entrenching the stranglehold which finance exercises. So this doom loop has a really long history, but the concentration of power and wealth in the hands of the new titans of finance, the extent of their penetration and influence over the financial and corporate world, the deep and wide imbrication of the Fed in the logic of big finance in protecting its interests goes much beyond what was witnessed before. The Fed's extraordinary interventions have ensured that the broken wheels of cash and credit are running again. But that disconnect between the rebound of the financial markets and the persistent buildup of jobless claims is a warning. It's a warning that finance is tightening its grip even more firmly in the wake of the pandemic. So private finance and the Federal Reserve are locked together in a doom loop. And this doom loop can only be broken if the balance of power, of class power, shifts to curb the dominance of finance. And the Fed is empowered to throw off the yoke that holds it hostage to finance through this doom loop. So it's really imperative today that the working class and progressive movements pay attention to the far-reaching consequences of the Fed policies in reshaping the balance of class power in ways that profoundly affect the lives of working class. And we push forward with campaigns and initiatives to make the Fed independent of big finance. Thank you.
Okay, thank you, Ramaa. That was great. I'm just going through the questions now. As a reminder, we are doing these lectures several times a week. We have another one up on Friday with Peter Gowan, who'll be talking about the Magder Plan and whether Swedish social democracy could have taken a more radical path towards socialism. In the meantime, there's a bunch of questions, so let me try to figure out the most logical order for them. I guess one's a more definitional question, so let's start with this. There was someone who wanted you to kind of repeat what you were saying about the difference between fiscal and monetary policy. So obviously the Fed would be fiscal policy, the Treasury would be monetary policy, but could you explain that a bit more, that distinction?
Okay, so fiscal policy is basically government tax policy and government spending. It's in the hands of the Congress, and the Fed, and to do it, the Fed can. The Congress or the state uses taxes and public debt to finance its spending. Mm-hmm. Right? That is fiscal policy. monetary policy, which is in the hands of the Federal Reserve, is basically what the Fed does to inject money into the banking system. And it does this to basically prevent inflation from rising. Its mandate includes kind of lowering interest rates when unemployment is rising to get credit flowing again. And increasingly, I mean, and the third important aspect of monetary policy is financial stability, preventing the markets from getting disrupted. So fiscal policy is basically under the control of the Congress. The Fed is independent and runs monetary policy. What we're seeing now is the Fed has kind of become a fiscal partner. It, apart from the things I talked about, it's also overseeing the Paycheck Protection Program, which is loans to small businesses through the Small Business Association. So it's become a kind of fiscal partner, and with the growth of financial channels, the use of debt to create credit and in the financial system has also blurred the lines. So that's what, yeah.
So what should
That's
we
clarified a bit.
No, that definitely is a great clarification. So there's another question that is on similar grounds, and it's a question of central bank independence to begin with, or independence of the Fed. So as socialists, where should we stand? Because obviously there's certain benefits when, of this independence when the central government is controlled by right populists or just as otherwise gridlocked or incompetent or whatnot. We're probably better off with an independent body than one controlled by the Trump administration directly. Though obviously in the U.S.'s case, it would be controlled by Congress. But let's say in a parliamentary system, controlled by like Modi in India, as opposed to in independence. But we can imagine how these independent central banks might play very dangerous roles undermining a left social democratic or even more radical program. So can you get into that question of independence?
Sure. I mean, and the fears which are being expressed are completely, are spot on, because you see the dangers, and I mean, we're seeing it in India, where suddenly we want the central bank of India to be independent of this particular regime, or in the US, you want the Fed to be independent of what the Trump administration's latest whims are. But the point is that that the whole push for central bank independence happened in a context where, in the context of the neoliberal backlash, which is give markets freedom, give finance freedom. And what this meant is you wanted the Fed to, and central banks to basically be freed of any obligation or accountability to the democratic state. So the point here is that it's that the central bank independence that we see today is a kind of illusory independence, because what it basically means is central banks in the thrall of private finance. What we need is, and the state, the US state too, is at the thrall of finance. So what we want is independence from this this control of finance, and that won't happen simply by giving the Congress a greater say in the running of the Fed. It'll happen through actual democratic progressive change in the Congress, in the political system. It can't be left to the Congress. The Congress has to be made accountable. The Fed has to be made accountable. And that requires a different envisioning of democracy. So we want the Fed to be accountable to people.
So, because otherwise they're going to be accountable.
Independent of vested interests.
Right, exactly. Otherwise they're going to be accountable to the forces of big finance.
Yeah.
So there's a question that's more about the framing that I put on this talk, which is I use the word finance capital to as a shorthand in the title. So I guess the question boils down to these dichotomies between the real economy on Main Street and the fake economy on Wall Street at a time when obviously finance is vital to, just
Yeah,
investment and expansion of regular production. And right now, obviously, the Fed's main role has been through the SBA pumping funds to a lot of small businesses in the form of loans and grants and whatnot. So I guess when we talk about the power of finance, we use words like finance capital. How do we avoid falling into the populist trap of just drawing a hard wall between the fake and the real economy,
mm,
while at the same time taking into account the fact that there is something fundamentally different that's been going on the last 30, 40 years with finance and its power being unleashed. So how do we separate these things?
so I mean, this is actually a really important point because at one level, um, capitalism is a financial system. You cannot separate finance from the so-called real capital, because the whole process of accumulation of building building productive capacity depends on financing, right? So, but the thing is that it's on one hand, finance is, you could think of it as the fuel or the lube. But it's also a social relation, and increasingly, it's harder and harder to separate finance from the real world. It's everywhere. It's really hard to think of a separate finance sphere which is fake, because it has very real implications. You it's So I don't think um, a useful construction to think of it as fake versus real. But what one should think more deeply about is what is being financed, what is the motive, what is the logic or the propelling power. And the thing about finance is, again, it's contradictory. On one hand, it allows you to innovate, it allows you to build capacity, create jobs, right? But on the other hand, there's this whole speculative risk-taking aspect. And when the prospects of making profits through building productive capacity, however exploitative that might be, get squeezed, then finance finds other ways to basically keep growing. And while it's not fake, there is a disconnect. Seeing this. The stock market boom is completely unreal in the sense that you don't expect, it's not rooted in fundamental economic kind of. It's happening despite falling profits. So there's no hard basis for it, but it still has very real implications.
So
Right? So
after,
and yes,
go
yeah.
ahead.
Yeah. Uh, what we're seeing is this deep independence. The whole development of the corporate form, with the development of the corporation, real capital, the corporation which is producing, everything from laptops to cars to whatever, is now a financial entity. It's a bunch of financial assets put together, right? So it's pretty profound the way finance has reshaped the way we organize production and lives.
So after the 2008 crisis, there was continued consolidation in the banking industry. You mentioned in your talk that, there's really four big players now in the financial industry. And the common response to that, on the liberal left, is kind of the Elizabeth Warren and to some degree Bernie Sanders call to break up the banks. So obviously we've seen in other systems, we've seen in social democratic systems, for example, a principle that you're fine with concentration, even in finance, but you just fight to regulate and even nationalize these sectors. What should our perspective be as socialists? Obviously, the one of the advantages of breaking up the banks is you're just weakening their power, or making it, you're creating a collective action problem for the banks by just disaggregating the power, which might make it easier to push through the kind of reforms that we need. On the other hand, as an end in itself, it doesn't necessarily accomplish the goal that we want, which is a more accountable, more democratic finance. So
Yeah.
so what would be your take there?
So I don't think breaking up banks is enough. I mean, it's not going to. It's And there are two reasons for it. One is that the nature of finance and this growth is, what does it do? It mobilizes funds. I mean, the savings of people all over the world are being kind of centralized, brought into the system, and then they're being passed on to where it can kind of earn the most, right? So, and to be able to do this, it requires building this huge social infrastructure where you're able. I mean, you need prestige, you need reputation, you need a network. So there is a natural way. I mean, in which there's an inherent tendency to become big. Okay, so it's very hard to contain, and then there's also inherent tendency to be speculative. So while I think it's really important to, it's we, this kind of concentration which is happening has to be stopped, because uh, how do you break the power of these big banks? But apart from that, I think there has to be a lot of, I mean, rules, regulations, ways, and which are continuously keeping up with the innovations which finance does, right? Because every rule and regulation means a new innovation. So to basically show where that this is what finance should be doing. And this is actually really hard, because nationalization is also not enough unless other social changes are happening. And China is a very interesting example where the state has actually tried to control and foster the rise of finance under its, and try. And despite this huge control by the state, the fragility keeps building up. And what it does is that then it clamps down with its full force, and then it builds up somewhere else. So it's not easy. And the only way one can do it is if the social relations are in some way different. And yeah.
Right. And nationalization itself is a limited option unless we also have massive civil service reform. Because if you have a set of state bureaucrats in there
Yeah,
that are coming out of the financial sector, that just think earnestly
yeah,
that in order to foster the economic growth, they need to fund social programs. Let's say they are kind of liberally, people. They're going to end up enacting many of the same policies. Like in Britain, the power of finance was unleashed under a Labour government, not under the
mm,
Tories, not under Thatcher. But let's see. We're running short on time, so I think we'll just get to one or two more. One question that we had was, oh, should we be worried about the rising deficit and the debt to GDP ratio rising in different countries, like in the US, for instance? Obviously there's been a big trend on the left because of the popularity of MNT and other ideas to just dismiss this as deficit hawkery. But even if, for example, it doesn't lead to a systemic crisis having this much debt, and this amount of debt, given how immense the US economy is very much sustainable, it might lead to a political situation where it becomes harder to advocate expansions of the welfare state in the next several years, or it becomes easier to imagine a new crop of politicians pushing for so-called entitlement reforms, raising the Social Security age 2 years or whatnot. So should we be worried about the deficit? And I guess if you want to take that further, I don't want to ask you. I mean, I'm actually curious to your thoughts on MMT and on these other kind of schools of thought that place much less emphasis on on debt and deficits than, let's say, you know, mainstream socialists, you know, have traditionally.
Okay. Uh, so the thing about debt is the debt of the US is different from the debt of Argentina. Okay. The US, because the dollar is uh, a global key currency, has a special position. I mean, so basically, the fact that the dollar is kind of used by all globally basically means that the US has a much more elastic credit line. As long as people outside the US, from central banks to investors, are willing to hold dollars and US treasuries, you're going to find uh, the debt by itself, or the rising debt to GDP ratio, is not a problem for the US. So, which is not to say that it's, um, eh, this can go on in an unlimited way. But the key is that that the management of public debt is also a kind of a power play, right? So if Argentina is on the verge of its ninth default, but in every default, the power play is to tighten the leash on Argentina, to open up its market to capital flows and integrate it deeper, so that in some senses, part of the fragility of finance gets exported and absorbed by countries like Argentina. And that every time that happens, there's a rush to the dollar, and the US dollar becomes stronger, and the credit line to the US becomes stronger. Okay, so that's the first point. The debt is what is critical is the market for that debt. As long as there's a market, China is willing to buy US Treasury bills. It's not a problem. But this market depends on a couple of things. One is the depth and breadth of the US financial markets. The fact that gives, that gives a lot of cachet to the dollar, right? And about 90% of transactions globally are done in the dollar. The other aspect is that that debt is also used as a weapon domestically. I mean, it's every time there's a Republican regime, the debt rises. Every time there's a Democratic regime, there's this whole kind of the deficit hawks kind of start worrying. And the reason for this, and there's a very clear political reason for that, because, and this is something which Kaleski kind of talked about. Why is, what is the problem with reaching full employment? We know we can just spend, and why can't we do that? It's because capital resists that. The capital resists that because it undermines its control, its ability to hire and fire workers. And that is why the social safety net and all these, these programs are always the first to be axed, right? Because it isn't the problem is not the debt. The problem is what it's being used for.
Right. The problem isn't how much we're spending on these programs. The problem is that if you give workers a credible exit option, they might not be able to go back to substandard jobs. Like right now in the restaurant industry, there's a lot of workers who are refusing to get off unemployment and go back to work, not just because the work is unsafe right now with coronavirus in states that are opening up, kind of irresponsibly right now, but because they're making more money on unemployment, because Sanders and others pushed through that measure which made it $15 an hour, and if you're pre-tip wages for service sector jobs is like $4 or $5 in some areas.
And what's also striking is the difference between the US and European countries, even UK, Germany. I mean, the way they have tried to basically support jobs and people who have lost their jobs or losing their jobs by basically preserving that and the way the U.S. has done it, right?
We kind of are encouraging people we were encouraging people to go on unemployment, and now through the CARES Act, we're encouraging employers to rehire people so they get a higher amount of their PPP forgiven as a grant. But a lot of these workers don't want to get off this, and you're going to see all sorts of fraud and manipulation is obviously going to be done. There's no way the government can audit all of the money and all of the businesses they've
And unfortunately, that'll be used to axe.
right. But a large part of your response is obviously based on the fact that the U.S. is in this particular role, this exceptional role, given the power of its currency and its use in the world, which gives us a lot of flexibility to do certain things. But these lessons might not be applicable elsewhere. So, for example, if you're a left nationalist government that takes power in the global South, you might have to really worry about your deficit because you don't want to have to accept IMF or World Bank bailouts in their term.
Absolutely. But even for the U.S., I mean, if its ability to get the advanced capitalist world together to defend the dollar wanes because of all the then this edifice might collapse. Now, again, one of the interesting things is that the dollar was propped through this whole pandemic. Where all other multilateral exercises or a global role for the US was non-existent except in propping up the dollar.
So the dollar plays this premier role, but countries still have reserves in pound sterling and in euro, right? So it's not the
dollar is about 60% of reserves, especially in developing countries.
So what role does China see itself playing in the future, especially as it relates to the developing world? So China is obviously very keen to extend loans and credits for development in the global South, obviously to pursue its own national agenda. I'm not pretending this is some act of solidarity from the Chinese Communist Party, but does it see itself as usurping that role from the U.S., or does it not have those types of ambitions?
Okay, so I mean, at one level, who knows? But what China is thinking. But my reading of this is that after 2009, China is the leading creditor of the US. It's a major industrial power, and yet it's kind of in the shadow of the US. It can't lend in its own currency. So it has a stockpile of dollars, and it's not able to. It doesn't enhance its own international role. So it was in some sense in the shadow of the dollar. And I think after 2009, this is what's called the balance of financial terror. It's got this huge stockpile of treasuries, but if it sells it, it loses there's a big hole on its balance sheet. So it's kind of in this peculiar position. And since then, it has been trying to, it's really rankled. So it started by saying, let's have a global reserve currency. That never went anywhere. And then it started this program to internationalize the renminbi. Now, I don't think it's trying to usurp the role of the dollar. I think it's a more pragmatic thing. And I think you could call it crossing the stream by feeling the pebbles. It moves forward, tries to internationalize, and then pushes back when things become too hairy. So it's doing this because it wants to be able to lend in the renminbi. It wants not to be dependent on the dollar. It doesn't mean that it wants to replace the dollar's role. I'm not sure it's ready for that or even wants to do that.
Right. Well, thank you so much.
A separate sphere. But.
Right. I think this could take us down a rabbit hole. It's probably a good place to end, and then maybe we'll continue on some future one. But thank you so much for all your time, Ramaa, for the talk. And
thank you so much for calling me.
Yeah, of course. And please do everyone check out her work. Her Catalyst and Jacobin essays are linked in the description. Please tune in on Friday for Peter Gowan, and press like and subscribe. That's how we get the video to more people. But thanks, everyone. Stay safe, and I'll see you soon.
Thank you so much.